Welcome to a scalping seminar. My name is Tom Hugart. I'm going to get back. I'm going to go straight to it. Um, Guys, um, first of all, thank you so much for XTB to organize this event. I would have loved to. Uh, I'd like to have traded live. So the first thing I want to say here is that this presentation runs over 300 pages, and I estimate that it will take about 5 to 6 hours to teach everything that I want to teach. But I think tonight I only have approximately 45 minutes at my disposal. So therefore, I'm going to jump um, uh, some slides to make sure that you have an idea of how I scalp. But I have put out a few videos on how I scalp on YouTube. So if you go to YouTube and you type in Tom Hugart scalping in YouTube, there will be about there'll be two to three videos of me scalping. I run a live trading channel where I post my trades in real time, and I've posted my trades over the last few days. I'm up nearly 3,000 points, which I admit is pretty easy to get if you were just short the market. So if you want to be part of the Telegram channel, but I don't scalp there because you can't post your entries fast enough, then you can find more information about it on tradertom.com/trading signals, or send me an email to hello@tradertom.com. Scalping doesn't have a widely accepted definition, and that does present a problem when you're talking about scalping. So therefore, for the sake of having a definition, I define scalping as the act of trading on a time frame, a very short time frame, in an instrument with sufficient volatility to warrant short-term trading, using no specialized, I can't actually spell, sorry about that, specialized equipment. So what I mean by specialized equipment is that I don't find it necessary to have to subscribe to a certain charting package. And I get very distracted by the comments that I get from YouTube, because I keep hearing people saying that my laptop I'm doing everything I can, or I hope I'm doing everything I can. So everything that I show you over the coming hour is done on a 5-minute chart. So good instruments to scalp is the Dow Jones index, as well as the DAX index, and to a lesser extent the FTSE 100 index. Yeah, get on with it. You're absolutely right. I think it might be worthwhile just mentioning here that at some point, whether XTB want to organize it or not, but I will do the entirety of this presentation over a couple of web seminars. So if you want to be alerted to this, stay tuned for XTB, or send me an email to hello@tradertom. Okay, so the origin of scalping actually started on the trading floors, and the essence of it is, I'm going to go through this really quickly, because I would prefer just to get down to the nitty-gritty of scalping. But you know, when you had floor traders in the old days, you had a broker. He would walk into the trading pit because he had an order to execute for the client. So he would begin to announce that he has an order to fill, and the floor traders would begin to shout out prices to him. So the broker walks in, there might be a floor full of locals and institutional traders, and they're all beginning to bid for the broker's order. And finally, he will settle on a floor trader or an institutional trader, and they begin to haggle about the price. And let's just say here that the price is for, you know, a contract of wheat, and the bushel is trading at 110 and 111. So 110, 111 is the bid offer price, or the sell price versus the buy price. And so the broker is obviously going to buy at the offer price, and the floor trader will then find himself in a situation where he will then make a market and they settle on, say, 111. So the broker walks out of the pit, deal is concluded at 111. So the broker, the client, have now done what they wanted to do. They bought the contract at 1.11, and if the price is unchanged, they are immediately 1 cent out of pocket. The broker, the client, gives up that 1 point or 1 cent to get into the market, just like what we are doing today whenever we are trading. So if they sell their position now, they will lose 1 cent because they will have to sell it at the prevailing price, which is 110 to 111, and you will sell at the bid price. So you'll be selling it at 110. But the floor trader is in a slightly different situation now, because the floor trader is now holding the position. Now he has made a market, so he has the advantage that he's short the market at 111. And in order to cover a short position, you have to buy it back. So he could immediately buy it back at 111. And if he did that, he basically just scratched the trade. But obviously, he will now begin to announce to the rest of the floor to see if he can get a better price to cover at than 111. If he gets 112, well, then he lost a pip or a point. And if he gets 110, well, he scalped that position for a cent or a tick. So the broker gives up the edge to get the business done. He pays the bid ask. But the local, he sells to the broker, and the local is now short. However, it's the local who now has an edge, because the broker is immediately out of the pocket by the size of the bid ask, but the local is at break even. Because the local have such a small amount of transaction cost, it makes financial sense, but now the work for the local really starts in earnest. And so the floor trader now has to get rid of his short position, and he'll begin to communicate to the rest of the pit saying, does anyone want to take this position at 110? And so if he can get it off at 110, i.e. if he can buy it back at 110, that means that somewhere in the pit there's someone who's gone 109 to 110. And as I understand it, this is known as scalping for a cent. So the local takes on the risk in return for a neutral position, but the local's role is to facilitate liquidity. At worst, the market will begin to move against him. At the best, the market begins to move in his favor. From a status quo perspective, he should be able to get out at break even, minus his transaction cost. If a local can do this many times a day, he or she should theoretically, over time, statistically speaking, make a near risk-free living. However, when you start factoring in things like owning a seat or renting or leasing a seat on exchange and include transaction cost, however small, the prospect for the local scalper is probably not as rosy as you had imagined. And on a trading floor, it was noisy, dirty, smelly. But a few traders like Tom Baldwin and Charlie D, Louis Borsellino, they actually made it quite big. Whether they were position takers or scalpers or somewhere in between, depending on the market environment, I don't know. But how is that different to what we do today as off-floor screen-based traders? Scalping in the online world, well, whether you trade with one or the other, I'm sorry, XTB should actually also have been in here. This is not a promotion for any kind of broker, I assure you that. It's just that the brokers that we are dealing with today, they are the new locals. So whenever we are trading, we are actually the one that is dealing with the equivalent of the floor broker or the local. So the typical CFD broker, he has three distinct advantages. He's always break even on entry. He has a two-way flow, meaning there's clients who will be buying and clients that will be selling. And he controls the size of the bid-ask spread. But the disadvantage that he has is that if his spreads are not competitive, he'll lose business. So if you are dealing with a broker that has a 5-point spread and you're dealing with another broker that has a 1-point spread, well, it stands to reason that you want to trade with the one that has a 1-point spread, because otherwise you're going to have to wait 5 pips before you are break even, while you only have to wait 1 pip before you are break even. And of course, any broker these days, any CFD broker, will also have their own risk parameter to adhere to. And only as recently as today, I spoke to a CEO of a CFD company in London, and he asked me, "Are you long the market or are you short the market?" And I told him what I was, and I asked him, "What are you? Are you long? Or are you short?" And he said, "Well, we're short." And I said, "Ooh, well, the market has just rallied 200 points. Why are you short?" And he said, "Well, because all our clients are long, so we tend to take the other side." The scalper's business model is slightly different. As a typical CFD scalper, we have four distinct disadvantages. If the spread is not tight, or if it is a variable spread, we are immediately at a disadvantage. We will always be behind by the amount of the bid and ask. We don't have a sense of the flow like a floor trader has either. We don't have any visible or auditory feeling of the market, whereas a floor trader in the old days had a sense of mood in the market by judging the noise level. And perhaps you could see some of the big brokers coming into the pit, and you could set and guess what their bias was, or he could follow some of the major traders, the major locals, or the maker professionals, and see what their bias was. But the problem that we have, it is often impractical for us to enter quickly in scalping using limit orders or stop orders. That means that we will never be able to buy, say on this quote here, we'll never be able to buy at 12,726. We will always have to pay 12,727. But we do have some advantages. First of all, we don't have any problems getting a fill even in big size. We may not have noise, but we have charts to aid us. Additionally, we have a really calm working environment with a clear focus. We are pretty much always guaranteed a fill, and we don't have to worry about latency. So this is sort of some of the circumstances that we are faced with. But before I dive into the actual setups that I use for scalping, I want to talk to you about the mathematical danger of scalping. While I'm certain that you think you're all immune to statistics, you should be mindful of a couple of things. Let's assume that you have a 1-point spread in the Dow or the DAX, and let's assume that you execute some 10 trades a day. It's probably not too unrealistic given the nature of scalping with quick entry and quick exit. If you execute, say, 10 trades a day and there's a 1-point spread, and you face that over 250 trading days, you're pretty much giving up 2,500 pips a year. And assume that you're trading £10 a point, you'll be giving up some £25,000 in silent commission. So if you engage in scalping, you have to exercise an extreme degree of discipline, an extreme degree of emotional discipline. Otherwise, your active trading activity will undermine your effort, considering the statistics. Just going to make sure that everyone is still okay. Seems like everyone's still on board. Cool. Now, all trading involves risk. I have been trading in my live Telegram channel today, and it has been, to say the least, very volatile. And every single time that I sit down in front of the screen, I risk my own money. I trade big size, and there's always the risk of being on the wrong side of a tweet from Donald Trump or whoever else the market listens to. And just because I'm scalping doesn't mean that I can't get caught in an adverse move. So without going over the obvious, if I set my stop loss too tight when I'm scalping, then I may run the risk of actually foregoing in a perfectly okay position. But if I set my stop loss too far away, it might be that my risk to reward ratio is good, but it will only take 1 or 2 bigger losing trades to wipe out the profits that I made from a large number of smaller profitable trades. Now, what I wanted to go through here with you is the statistics that I use when it comes to um, to to ascertaining my risk parameters. But as you can see here, I have a lot of data that, although I find it very relevant um, in order to optimize my scalping approach, it would also leave me with no time to go through the stuff that you really want to hear about, which is how I scalp. So I think what I would like to do is to make you a deal, and that deal is that if you email me, I can send you the notes for this presentation, so you can at least look over the statistics yourself. It's quite important, statistics, because uh, just very quickly, so you get an understanding. Uh, Over the last 24 months, I have classified the trading environment in the Dow Jones Index according to a color coding. And the color coding here is that if the market is extremely volatile, I define that as the true range is more than 500 points on the daily chart. I classify that as extremely volatile. If I then split it up by the half hour, the average 10-minute chart, the high minus low on a 10-minute chart from 2:30 till 3 o'clock in the afternoon on days when the ATR, average true range indicator, goes above 500, the volatility is 120 points per 10-minute bar over those three 10-minute bars from 2:30 till 3 o'clock. And as the day wears on in extremely volatile situations like the one we have right now, it gets as low as 67 points, which is from around 6 p.m. to 7 p.m. UK time, and then it gradually increases again towards the close. So there's an initial volatility, it dies off, and then volatility picks up again. Now, why is that important? It is important because if you are trading an extremely volatile time, as we are, for example, right now, you have absolutely not a chance in hell to get any decent trades on if your stop loss is too small. If you go into a very small trading range, you can see how significantly less the volatility is. So I would really like, from a professional courtesy, I'd very much like you to study this, but perhaps not study it now, because then I would spend all my time actually just talking about statistics. And I think what I would like to do is I would prefer to talk about the stuff that I think you would like to hear about, which is scalping entry techniques. So before I start with breaking down or going to the semantics of scalping, I want to say to you the following: scalping is an art form. It's not a science. If you have an algorithm, then it probably is a science. But I am a typical old-fashioned point-and-click trader, and that's why I urge you to go and see the videos that I have put out on YouTube, because it will give you a much better idea than what I can do in this seminar, what scalping is for me. Whether the volatility is high or low when we are trading, we still have to figure out whether to buy or whether to sell short. And how do we do that? Well, we tend to use a trend estimator. So when we're sitting trading, we might be thinking, well, there's a double top and I'm going to sell short, or there's a double bottom, or a Fibonacci ratio, or whatever nonsense that you use for getting in or out of the market. But the problem with trend within a highly volatile environment is that the trend tends to get washed out or drowned out on a very, very short time frame, like a 1 minute chart. So the setups that I want to show you, they are not that trend dependent. So the first scalping technique that I want to discuss is what I call buy on close. So buy on close is an entry technique actually on its own right, but the close is important. So if we are focusing on a 5-minute chart, which is what we are doing right now, when we decide to exercise a buy on close, that means is that we will be watching, say, the 5-minute chart from 3 in the afternoon till 3 in the afternoon. And basis on where the market closes at 10 minutes past 3 o'clock in the afternoon, we will then decide whether we want to be a buyer or a seller. The close is important. Is there a tail or is there no tail? The length of the bar is also a consideration. Is the market trending, expanding, or is it contracting? So what I would like to do is to show you some examples on a 5-minute chart, and then break down the individual trades. So let's see if we can do this practically here. Wow, the Dow is volatile tonight. It would have been fantastic to scalp this. So here's a chart of the DAX from the 21st of October. And what I want to do is to give you an idea of how a chart like this could be scalped. Now, granted, I'm going to give you the full picture, but as we go through the chart, I'm not going to give you the full picture. Rather, I would prefer just to give you a little bit at a time. So if I put the laser pointer here. So the market opens at British time, 8 o'clock in the morning, and we have a green bar, we have 2 red bars, and then we have a full-blown bull bar and another full-blown bull bar. We're focusing our attention on the 4th bar, which is this bar here. The 4th bar is what I call a full-blown bull bar. Now, sorry, this bar here is the 4th bar. Some would argue that it is still within the context of a trading range and care should be taken if buying on a scalp. But imagine that you can't see this 5th bar here. Why would you consider buy on close on this 4th bar? Well, there's a couple of things that as a scalper that you'll be aware of. First of all, we have an expansion of the range from the previous bar and the bar before. Secondly, we have very little tail at the bottom. And thirdly, we have very little tail at the top, which suggests that there will be follow through, because more or less where we closed, the market traded up to. But if we ignore the 4th bar and we go to the, if we decide that we're going to short the 4th bar because we still think it's in a trading range, we have to at least be mindful that at 20 minutes past 8 in the morning, the DAX market is still pretty young from the open, and neither trend nor trading range has been established. The 5th bar, which is this one here, is what we call a breakout bar. If we are focusing on the buy on close, that means that what we're seeing right now is what we will be faced at exactly 25 minutes past. So the question here is, it doesn't close exactly on its highs, but the odds are very high, basis this pattern, that we would at least see the market get above the top of this 5-minute bar. So I consider this constellation a worthy buy on close setup. If you do buy on this setup, you will have two options on your stop loss. Your stop loss could either be below the low of the actual setup bar, or if you want more risk, you'll put your stop loss below the low of the last swing. If you do that, the odds are less that you're going to get stopped, but you will have significantly increased your risk. Excuse me for 1 second. So for conservative reasons, we'll say I will put my stop loss underneath the low of the actual setup bar. The next bar is a red bar. It held above the low and as such made what we call a higher bottom. And although it didn't manage to get above the previous bar, it still managed to make a higher low. Now, when you have a trend higher on a 5-minute bar, you rarely get more than 5 to 8 bullish bars in a row. So what complicates the picture here is that we've had 3 bullish bars, but it has been interspersed with a little, this is a 5-minute bar. And if I turn the time axis to a 1-minute bar, this 5-minute bar you see here would consist of a handful of 1-minute bars that would see a slight retracement. If I bought on close, my stop loss as a scalper would be the low below the current bar. So if I then am presented with this setup right now, if this is what we saw as traders, would we be buyers here or would we be sellers? My argument here is that this current bar where my laser pointer is over right now is that this is the kind of bar, it doesn't get much more bullish than this. There's barely any tail at the low, suggesting that the moment the previous 5-minute bar closed, the buyers immediately started buying. Secondly, it is the longest bar for the day so far, and there's zero tail at the top, meaning that when the market closed, once the 5 minutes were over, there was no sellers at all. Sorry, of course there were sellers because there had to be by definition if there's buyers, but the market was bid up to the very highest point when the market closed. So as a buy on close scalping technique, I would argue that this is what I wanted to buy. So even though you're a scalper, you also do need to be aware of support and resistance from the previous trading day. Now for this example here, I am not including anything from the previous day, so we have no way of knowing if there's any resistance up over here. As you can see, ladies and gentlemen, I need to say this to you. One of the problems I have with doing seminars, and one of the reasons why I love having the Telegram group where I trade live, is because anyone can appear wise and a sage when they have the facts in front of them. But if you are asked to trade live, there's no hiding. You don't know what's going to happen any more than the next person does. And so when I go through a web seminar like this, I am quite conscious of the fact that I already know what's going to happen. And while I try not to let that seep into my teaching, it is inevitable that you do appear like a little bit of a smug because you already know what's going to happen. And that's why I prefer to actually teach in a live environment, because you as a student gain much more than you do from after the fact. Anyway, I just needed to say that. The problem that I'm faced with now is several fold. There may have been a prior top that I can't see on the current chart, so we'll discount that possibility. Every bull bar so far on this trend up has been interrupted by a one bear bar. Now, none of these bear bars managed to take out the low of the previous bar, so that's fine. But what we're seeing here is that this is a rather significant red bar, and it separates itself from the past red bars because it actually closed on its low. So if I had bought the market here on a buy on close, which is perfectly doable, or if I had bought here and perhaps I've added to my position up here, I would actually begin to think, am I in the right position here? Because this bar here does exactly the opposite of what I wanted to. I don't mind a red counter bar, but I prefer not to have one that closed right at its lows. So if I didn't have a position at this point, if I looked at a chart like this, I would be thinking, I think the market may just pull back a little bit. If I had sold short here because I'm thinking, well, this is a sell on close scalp with a stop loss above the most recent high, I suggest I might just have a much better chance of a profitable position. I may have two strategies here. One strategy is that I sell on close. The second one is that I actually sell the moment the market goes below the prior bar's low. So the current chart needs careful explaining, and for that reason I have magnified it. I've blown it up, so to speak. So I'm just going to show you the next slide. So here's a real close-up of how I would have tackled a chart like this, and I readily admit that I didn't choose an easy chart. I didn't want to make this easy, neither on you nor on me, because if I chose an easy chart, you wouldn't gain anything out of it when you're then faced with scalping yourself. So point number one, which I've written just underneath, so this number one here correlates to this chart, to this bar here. Point number one, bears sell below the low and bulls will buy below number one. So what you're seeing here is that on this bar here, we number two, there will be those that we buyers below this low here, because they're thinking that the market is just pulling back a little bit and we'll see higher prices. Then there's those who will believe that actually they should be short underneath this bar here because it's a significant bear bar. The bears actually force a lower low on bar number two. Bar number three actually forces a higher high and a lower low. So the bears still managed to push on bar number three, managed to push the market below the low of the previous bar, but buyers immediately stepped up. So the bar that I'm focusing on right now, where the laser pointer is, if I saw that isolated and I didn't know what the next bar would be, I would make an argument that says that this market was probably going to be ripe for at least another push higher. That means that as a scalper, if I bought when the market closed, even though it didn't have a particularly convincing close, and a convincing close would have been if it closed at its highs, but it didn't. There's significant tail on the upside and there's significant tail on the downside. But given the fact that we managed to make a new low and the bulls pushed it back up again, suggests to me that we would at least see a test of the highs where we closed. If we then look at bar number three, if it really had been bullish, the sellers wouldn't have been able to overman. So as a scalper, one of the traits that we have to welcome as scalpers is that we have to be able to relatively quickly swap from being bullish to being bearish. This is not us sitting down with the Financial Times thinking, oh, I think that the wheat prices are going to go up over the next 9 months. No, as a scalper, we have to have an extremely flexible plasma and an extremely flexible ability to change our minds the moment that the market changes its tune. And I think that in itself is probably the biggest challenge to scalpers, is that how quickly you can go from being a seller to being a buyer, or vice versa. So bar number 3 actually starts negatively, because we start here, and whether we go up here and then go down here, or we go down here, up here, and then end down here, I don't know. But the fact of the matter is that where the market was supposed to succeed, which is above 0.3 in this blue line here, the market fails. And if I had been a buy on close here, and I saw this, and I had a stop loss down here, and the market closed here, now the odds have gone from, well, hang on, you failed above the old high, and then you closed down in the mid-range again. I would expect that this low that we made here should be tested again. So do you, I'm wondering if I have lost you all, if you're all tuned out. No, you're still there. Okay, well, God bless you for still being here, or whatever religion you subscribe to. But this is scalping for at its absolute worst. It's tricky, it's challenging, and it can get mighty messy. My point here is that bar number 4, what I'm seeing here, makes a new high, but there's no buyers around. And if I sit and I watch this, I would be more inclined to suspect that there will be more downside. I readily admit, ladies and gentlemen, that my favorite setup as a scalper is when the market makes a full-blown bear bar or a full-blown bull bar without much of a tail. So same chart again, but before we move on, the concept of buy on close or sell on close, it's still a scalping technique, but it does require a very good grasp of several aspects. Limit buyers or limit sellers, what are they doing? And stop buyers and stop sellers. So let me go back to the previous chart and tell you what I mean by that. Those people who are buying above here on a limit order, sorry, on a stop order, they're the ones who have placed an order to buy it up here. It could also be people are being stopped out. And those who are sellers, they are limit order sellers. So they're stop order buyers, and limit order sellers will compete above the high of the previous bar. So the question here is, who won? Well, there's no doubt in my mind that it's the limit order sellers that have won this battle here, because they managed to force the market back down again. So if I sense that the market is headed into a trading range, I need to do the opposite of what I would do as a normal scalper. So if I see a strong bull bar, but still in the context of a trading range, I would actually sell short. And if I see a strong bear bar, but still in the context of a trading range, I would actually sell. Now this is very important for what you're about to see now. So identifying a trading range is not particularly easy. You're going to have to make an assumption, but then again, everything that we do as traders is making assumptions. We assume that the trend will continue, or they assume that the trend will reverse. So making an assumption of whether a trading range has now been established maybe not be such a stretch. So if you are confronted with what you're seeing right now, would you be a buyer? Would you be a seller? Well, the fact of the matter here is that the market didn't close particularly strong. We had a market which sort of closed in bullish, but it didn't close at its highs. We're wondering, well, will the market sellers conceive this area that we're seeing over here? Are they thinking, well, actually, we need to be sellers here? And if so, if they're sellers, where would the stop loss be? If I'm faced with something like what you're seeing right now, I would be inclined to scalp short. The reason why I'm scalping short would be, well, I got a high and then I got a secondary high, and actually we're pretty much just keep making lower highs and lower lows. Whether this bar that we're seeing here, it didn't close at its bare low, but it's certainly a negative bar, very much like what we're seeing here. We then have a trading range, 1, 2, 3, 4 bars, about 20-25 minutes. We made a double bottom, what we call a micro double bottom, and we now have either resistance right here or we'll have resistance here. Give yourself 5 seconds to make up your mind. Would you be a buyer here, or would you be a scalp buyer, or would you be a scalp seller? So let's see what happened. We'll go. So the market seems to have actually established a trading range now. So the problem here is, I don't want to oversell the idea that scalping is easy. It really isn't. Scalping is no easier or more difficult than, say, mean reversion or trend following or Keltner channels or Bollinger Band. But when you are in a trading range, this is very important, what would appear to be a bull bar, a scalp buy setup, if it happens within the context of a trading range, it is actually a sell. And if that happens, then this, what we're seeing here, would be a buy setup. I think many of us would be hesitant to buy this bar here, purely because it's a very negative close. But what you have to remember is that it's a very negative close within the context of a trading range. And if you bought here, it's not like you're going to have a stop loss down here. Well, unlikely. And if the market then begins to make further inroads down below support, well, then you are out. You're going to stop yourself out. But the premise for buying here is that the market still is in an uptrend on the big picture. But what we're seeing here is a larger correction. We are now settled into a trading range, and in a trading range, when you have bull bars in a trading range, it makes sense to sell them short. And when you have bear bars in a trading range, it actually makes sense to buy them. Now, this is something that I have had to face. This goes completely contrary to what my instinct would be. My instinct would be what I would want to sell short that. But through bitter experience and analyzing my own trades, I've come to the conclusion that this strategy actually makes much more sense over time. That also means that up here, I would be a seller right here. I would be a scalp seller. Now, this is a perfect example of how to handle a losing trade. If I'm in a scalp position and I've sold short here, where's my stop loss? Well, my stop loss would probably be, say it was up here. This bar here doesn't do much, but the fact of the matter that it closes above the entire trading range is something that I, as a trader, pay very much attention to. I pay an inordinate amount of attention to whether a market closes above a significant bar or closes below a significant bar. So what you're seeing here is the rest of the trading day. I'm going to sort of give you an idea of what it would be like to sell short in a trading range there, or buy a significantly red bar in a in what I call a trading range. So the vital criteria for a buy on close would be a strong close. But if it's in the context of a trading range, I would be selling short here. Your stop loss can be down here, or you can even have a more conservative risk profile, in which case you would have your stop loss sort of a little bit halfway down a major bar, if you don't want to have a stop loss all the way down here. For me, this is about as ideal as a buy on close setup comes. The odds of continuation are high. Stop loss could either be here or down here, depending on what your risk profile is. The tighter your stop loss is, the higher are the odds that you're going to get stopped out, but the smaller is your loss. Now, one thing that we haven't spoken about at all is how to take profits. Now, taking profits is in reality much more difficult than getting into the market. So I put here sort of rather blasé, targets set according to research on volatility. And that's why I want you to read the statistics that I had presented, but that I prepared for you, but I haven't had time to present here, simply just because I got too many slides. I mean, as I said, this is a 300-page presentation. Say for the sake of the argument that we had bought here, because we think, well, this is a strong bull bar. My argument is that if we close below the low of this bar here, then we have no place of being long anymore. But it's so important that you understand the difference between a trading range and a trending market. If we are on a trading range, those strongly green bars need to be sold and the strongly red bars need to be bought. But if we are in an expansionary range, i.e. we are beginning to trend, then we need to scalp buy these bars here. If we had bought here, where would we take our profits? Well, my argument has always been, when I'm in a position, my first priority is try to get my stop loss up to break even. And then I'll worry about taking profits. Now, just because I'm scalping doesn't mean that I'm going to go for 2 or 3 points. By no means. If the market actually wants to move higher, or if the market wants to move lower on a sell on close, but why is this not a trading range? It's not a trading range because we keep making lower lows and lower highs. That means that I would want to be a seller here. But again, I think I could make you converts on this if you saw me trade live, rather than doing it on a piece of paper that we already have all the answers. The skill lies in applying this in real time, not after the fact. Right, I'm conscious that I was going to speak for an hour, and that's what I've done. Do you guys have any questions? Well, I think there's quite a significant delay. if I show a chart, I wonder if you'd be able to see it. I don't think I'm not promoting any other broker here. I just don't know if you can even see it. Oh yeah, you can. Okay. Let's see if we can do some it'll be paper trading. So let's see if the principles that I've tried to establish here, am I okay to do this even though it's a competing charting package, because the brand name isn't shown here at all, so hopefully it's not going to cause any consternation. I hope. If it is, then I'm really sorry. Okay, so the argument here is that if we are in a trading range, then we should be sellers right here. Okay, right. Well, would that have paid off? It would have. We would have been a seller approximately at 27,050, but we are in a trading range, and it's a bit extreme, but we would have had at our most had a 90-point profit. Probably wouldn't have gotten 90 points out of it. So let's see if we can have an opportunity here. This is the live trading bit that can be a bit boring. Come on. Yeah, maybe this was a bad idea, because we'll be sitting here waiting for the market actually to close. But I think a lot of people think that scalping is a very hectic activity, one where you are gung-ho and you're executing hundreds of trades during a trading session, but you don't necessarily have to. You can actually be relatively composed if you decide to trade basis of a 5-minute chart. This is a classical sell on close right here, this bar here. At this point, we don't know this is a trading range, but since we're making a micro double bottom and we are making, we have to assume that this is a trading range now. So that's why being a seller here is a good idea. If I was forced to do anything right now, I would be looking to sell. But I would prefer to be a seller up here rather than being a seller down here, because if I'm a seller down here, I need to have a stop loss all the way up here. And that top is 27,083, and the market is trading about 120 points lower. So I'm not gonna have a stop loss of 120 points right now. I'd rather mark my time. So I'm just going to go through some of the questions. Do I use moving averages for direction? No, I don't. If I really want to be adventurous, I'll put on a 10-minute chart, and I'll simply just gauge the market basis of a 10-minute chart. Actually, the 10-minute chart shows us something here that the 5-minute chart isn't showing, which is that we are on a 10-minute chart on a trading range, and this bear close here was actually a buy. Would you believe it? It just didn't show up very well on the 5-minute chart. So maybe we are going to have an opportunity to do something here. One sec. I'm going to be interested in seeing what the delay is here, so I'm just going to click on my computer clock. So it looks like that there's approximately a 15-second delay on this OBS. This is still a 5-minute chart that we're looking at right now. It's interesting. If we get an opportunity to meet again, what I would very much like to explain to you is the significance of being a seller at, say, double tops or a buyer at double bottoms. But it's no coincidence where we stopped right now was at 20,007 and the old high was 20,007. Anyway, I think what I'll do now is I'll pause here, and then I'll say thank you for today. I'm sorry about the technical issues. You can blame it on me. I don't consider myself a relic when it comes to IT, but I'm not quite familiar with this OBS software. I will be next time. More than happy to do another web seminar in the very near future if anyone is interested in that. So maybe XTB will set it up and I'll open an account with them and I can scalp using their platform. Just going to go through a couple of questions. Do you ever use a 1-minute chart? Yes, I do if I am really desperate for a trade, but the market needs to be rather boring for me to use a 1-minute chart, because that would just suggest that I'm looking for action. In the old day, what's your name? Your name is Russian. In the old day, Russian, I used to trade on a tick chart. That means I would get my e-signal data feed to show me a 20 tick chart or a 50 tick chart, and I would be trading the Dow futures. But it just got too much, and I prefer this way, and I think this way is more profitable as well. But you know what, I'm not going to say that one trading style is more profitable than another. I'm too old for that. I've been in this game long enough to know that what makes you a profitable trader has very little to do with the trading technique that you use, and has everything to do with how you think while you are in a trade.